It's Brian Preston, the money guy.
Let's talk about the difference between active management versus index investors and what they do. There's this thing called turnover ratio, and it's not uncommon for active managers because they're always trying to find that, they're trying to do the buy low, sell high. So they're making decisions, and they got machines and computers and artificial intelligence running all these different type of algorithms, hopefully trying to create that great alpha, better rate of return.
Right.
So every time you do that, you're creating a transaction. Well, there's cost to the transaction, but then also every time you is in a taxable account, you do those transactions, that's a taxable event.
Yep.
So those are things that are going to have to be distributed out to the shareholders if you're doing an active management mutual fund. Index funds, here's what happens with them. You'll have an old company, like let's think about like Kodak.
Okay.
Kodak at some point was on an index.
Kodak, what's that?
The camera company. But then, as we quit using cameras and we start using our phone, Kodak gets pushed off the index.
Right.
It's no longer on the S&P 500
Right.
or whatever. So they make room and they put, Google or
Yeah.
Apple or some, whatever the high flyer that's, the new company that's replaced the old company. Well, that's not that much turnover.
That's right.
So you might see, a 2% turnover just because you don't have a lot of companies changing over. And that's all that changes in the index. So there's not a lot of buying and selling or turnover, and there's not a lot of transactions that create taxes. So let's talk about what that looks like. Because I knew when I tried to explain it, I was like, that's not going to hit everybody. So let's actually put this into an illustration that people understand. So what I did was I went and pulled the 25 largest U.S. mutual funds.
And I love that you did this. Again, in the live chat, you're about to say one. Somebody's already thrown that name out here in the live chat, which I just think is beautiful.
Look, we don't give recommendations on the show. That's just not the thing, because we don't know you as an individual. We don't know your age. We don't know your risk tolerance. It'd just be inappropriate.
But we'd love to know you and your age and your risk tolerance. So if you're looking for, I'm just throw that out there.
So how do we have? So what I did was I chose the 25 biggest because that's the easiest way for us to go choose somebody to use as a case study. Yep. So the number 19 on the 25 largest, because realize a lot of these are index funds. So I had to go a ways down to find actual active managers who are in the top 25. Number 19 was the Fidelity Contra Fund. A very popular fund.
It's one we're very familiar with.
Guy has an expense ratio of 0.74%, just to give everybody kind of an update of what's going on. But listen, we're talking about tax efficiency in this section. So in 2018, they had two big distributions. They had one on 12/7 was the record date, and then February 9th. If you added both of those up, the one at the end of the year was 7.2%. The one on February 9th was 1.5% of net asset value. If you added those two together, it was a distribution in the year of 2018 of approximately 8.7% of net asset value.
So what that essentially says is that 8.7% of the value of your holding was released to you in a taxable distribution.
Somebody who has $100,000 of Fidelity Contra Fund would get an $8,700 taxable distribution.
Yep.
It wouldn't be all taxes, but it would definitely be income that would be included. So that leads to the next one. Number 21 on the list of top 25 is American Funds Growth Fund of America, ticker symbol AGTHX. Their expense ratio, by the way, is 0.62%, and they distributed out in 2018 12.5%.
12.5. That's big.
So same example. You have somebody who has $100,000 invested in the Growth Fund of America. That's $12,500 of taxable income they're going to have to put on their tax return. So pay attention to that. So then we go and we look at, well, what's the number one index fund? Well, it's the Vanguard 500 Index Admiral Share, VFIAX. That's the largest in size. I said, okay. By the way, its internal expense ratio is 0.04%.
So again, just a fraction of the two active funds.
They did have, as the Admiral show, they did have a footnote that if you were over a certain size, it went down to 0.01.
Okay.
I didn't write down what that was. But if you added up, therefore, what I thought was interesting is these distributions were paid out quarterly. Those are probably dividends and other things being paid out, which might have a more favorable tax treatment anyway. But just apples to apples, the total comes out to be 1.91%.
And I want to clarify something here, Brian, because you just said one of the funds paid out 12.5% and the other paid out 1.91%. That's not rate of return. That's not like one fund made 12.5% and the other made 1.91. That's not what you're suggesting here.
No, there's taxable distributions. Mutual fund companies at the end of the year will have huge they have distributions that come out. And you're like, well, that's good. I like all that extra income. I'd like to have 12.5%. What you don't realize, they actually lower the price of what the shares trade at to bring it down. You basically just get the tax bill.
That's it. You're not actually making money on that. You are breaking even and paying the tax.
So don't fall prey to that, because that's a great point, Bo, and I'm glad you clarified that. So it's more of, this is what you're going to pay taxes on. It's an embedded gains. That's why we always like, I'll tell you, this is not in my show notes. When we go through like a crisis like 2008, 2009, I can remember when one of the key stats we'd look at in portfolio design was how much in deferred losses were built into these mutual funds. Because you could buy into a mutual fund that had a 30% deferred loss because of the downturn of the Great Recession. That's awesome, because that means that your fund can make a lot of gains before that manager is going to start distributing those gains to you, the shareholder. There's a 30% head start in there.
That's right.
It works the same way when we're in a really good period of market where you might have deferred gains that are sitting, embedded gains that are sitting within your mutual funds, that even though you buy it, you're going to pay tax on that money when it's divvied out to you, even though you didn't participate in that gain.
That's right.
And that's something you need to be very aware of. But going back to my $100,000 example, there's a huge difference between $12,500 for the Growth Fund of America, $8,700 for the Contra Fund, and then there was the Vanguard S&P 500 fund at $1,900.
Right.
And if you look at the tax impact, the $12,500 probably is going to generate, and I just did 15%.
Sure.
I did a very conservative 15%. That's $1,875 of taxes. The $8,700 is $1,305 in taxes. Meanwhile, that index fund is only going to generate $285 in taxes.
And remember, the less that you pay in tax, the more you let to keep your money working. The more soldiers you keep in your army of dollar bills.
So we've got it costs significantly less. They're significantly more tax efficient, meaning that's more money in your back pocket. The third thing I'd written down on why index funds do so well is that the behavior and structure of large 401ks. I mean, we've got a pile-on factor. Right now, we're totally getting the benefits of economies of scale. Is that you got all this pooled money coming in, all these guaranteed money that's coming in to the market every month with the dollar cost averaging of retirement plans. It's just a pile-on, and they're getting cheaper. They're getting cheaper, and you are the beneficiary of this. So take advantage of just the structure of this. Is where Fortune 500 companies, they're not buying active management. They're usually, I mean, you see them at Fidelity, you see them at Vanguard. I mean, when we deal with clients, they're at the big guys.
That's right.
They're at Schwab, they're at Fidelity, and they're at Vanguard typically.